Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to Cycles TV. My name is Lars Fontin, and today we are talking again about cycle analysis. So once a week, Monday, same time, same place, time to talk about cycles. We're doing dynamic time cycle analysis, so we're using real market data, apply our toolset from the foundation to detect the most dominant cycles in this specific asset class and do some projection and talk about the specifics of this cycle on real data. Said that, today I want to first, let's do an update on the US global stock market using the S&P 500. In general, there's still the same cycle which is seen here, but there are some special conditions or even variations which can be seen if we apply the future line of demarcation concept from Hurst and a little bit of harmonic theory from the weekly to the daily series, because these two additional concepts will help us to fine-tune the exact situation of the long-term and short-term cycle, as it's always important to fine-tune the timing, phasing, and the possible shift due to the dynamic nature of cycles. So we will not reveal new cycles. We still have the condition I often hear repeat on this analysis, but FLDs and harmonic analysis helps us to fine-tune the phasing, the dynamics of this cycle, and therefore I think it's one of the best real life examples we can use today to make this tangible, visible, explain it to you on real data where we are today. So we are live. At the end, as always, I will pay attention to your questions. I will try to monitor in parallel, but latest at the end we will get back to your questions. Okay, let's start with the long-term cycles on the S&P weekly. Therefore, I will start using a long-term view using, let me go to the chart here, using weekly data on the S&P 500. And the first analysis and discussion I want to do with you now is I'm doing a very, very long-term analysis going back into, you see the dark blue data used here, going back into 1928. So we are using around 100 years of data on the S&P 500 for the long-term analysis. So now you might ask, Lars, you always tell us don't use too much historical data. That's still valid. The reason I'm using this huge amount of historical data is just for one purpose. I'm interested in the average wavelength, so the length of the nominal 4 years cycle. Because the nominal 4-year cycle, or specifically 4.3-year cycle, has been listed by Hurst in his nominal model of cycles. And therefore, let's see, using the latest data up to today, if we can find this nominal 4 years cycle in the weekly data, and what, taking into account almost all data we have on the S&P 500, including the last final years, what the average wavelength would be. Not using this for forecasting. Yeah, that's the important difference I always make. If we are just interested in an historical analysis of the average length, you can use HMAT history as you have. So the first chart I will show you is just for checking if there is a 4-year dominant cycle in weeks and what the average wavelength would be. That's what I'm interested in. So therefore, I'm using more or less all weekly data here, and then I'm going to the spectrum results of this data. You see here we have now over, just zooming in here, over 5,000 data points going back 1928 to 2023, 5,000 weeks of data in our analysis. And if we look down into our spectrum, there is a clear dominant peak seen at 182 weeks. It's green, it's a large triangle. I mean, we don't need any artificial intelligence to detect that this is a valid peak here in the spectrum. The only other one would come into place here, but this is for sure a clear visible peak at 182 weeks. So now, the nominal 4-year cycle consists of around 200 weeks, 200 to 210 weeks. So yes, the nominal 4-year cycle converted to weeks would be 210 weeks. And now from the dynamic component with the average wavelength using of the historical data, it would become 182 weeks. So yes, the 4-year cycle is very dominant in past data with an average wavelength of 182 weeks, which is the 4-year cycle, which we see here in the data. I'm just showing this, not using for any projection, because for the projection we need to know the current phase, so the timing of this cycle, where this amount of historical data would not help us. But now let's assume we can validate a 4-year cycles there. Let's now shrink the data, not because now we want to move into the future. Therefore, using now weekly data with the standard setup, and you know that in the standard setting, we start with around 850 bars, which is, I often explain this here, the minimum length I would like to see to make valid projections. So only going back into, in that case, for weekly data up to 2007. So what we see here now, the spectrum looks quite different, but again, we see the dominant cycle of 82 weeks. And by the way, this is the cycle we are following since October 2021 here. So if you're following this channel, this cycle, you should quite be familiar with it. And we are following the phase and the projection of this cycle for 1.5 years. So now activating this cycle on our weekly data, and ta-da, that's now the projection we get. And now it becomes interesting. As said, I think I highlighted this cycle here first in September 2021 from different data sets. It was confirmed by different data sets, indicating the major top here in the markets and projecting the possible low of this cycle. I think the first projection was March, April, and now I have reasons to shift it a little bit into the future, but the theoretical cycle, and that's now where we need to add better mechanics and frameworks, looks like bottoming. But this is the theoretical cycle. So we are quite not sure if we are more to the left of the real price low, or if have we already passed this low and already in the upswing here. So from a theoretical point of view, we are exactly in the bottoming window. But I mean, you know that price is dynamic. We don't see this asymmetrical cycle, this symmetrical cycle as perfect as a sine wave would look like. So So now we need additional information and data which could guide us. Are we before the possible bottom, or have we already passed this point here? Because this pure cycle does not give us a clue on that. And therefore now let's add another cyclic concept which really can give us additional hint on where we are in this bottoming process based on real price action. So we know up to today how price behaved from the top of October last year. And we can use this information to do two things. First, let's see if this 182-week cycle has been confirmed. So was it really a top in October 2021 for the 182-week cycle? And second, what information can we derive in regards to phase shifting or time shifting, so the skewness to the left or the right? And to do that, that's when the future line of demarcation comes into play, a concept of Hurst. So I will refer you, you can Google the concept of FLDs. In general, it's a very, very simple and basic concept, and it's based on the pure theoretical sine wave. So you use the dominant length of the cycle. In our case, we're talking about 182 weeks, so the 4-year nominal cycle. This is the cycle we want to track and to validate. Once you know the cycle length, you can shift this cycle, so the cycle, half of this length into the future. Yeah, and then from a theoretical price movement, you would see exactly at the midpoint crossing these cycles. But I would leave it up to you. Google the basic information of an FLD. But what we do is we shift price, so we don't shift a theoretical price a cycle. We now shift the real price behavior, half of the dominant cycle, into the future, because we don't want to theoretically show something when cycles cross other cycles. We now can see if price is following the cyclic behavior, and at which point in time we see the crossing of the shifted price by half of the length of the dominant cycle and the theoretical cycle. And that's the so-called future line of demarcation. And once this point and cross, we can derive some information. And I will do this now live with you here together. Just the quick one. So you can activate FLDs within our latest release due to end of May, which is just the shift of price into the future. So the green line you see here, it's just the shifted price into the future. So it couldn't be similar. What you need to know is, how much should I shift this into the future? Now we have the information. The dominant cycle length is 182 weeks. We know from the concept of FLDs, use half of that length as an offset, to shift price into the future. I will even simplify this a little bit, which means that we will shift price into the future by 90 weeks, half of the dominant cycle. So this is now shifting the price behavior by 90 weeks into the future, nothing more, nothing left. And I will now explain some real interesting observations. So first, you see the low point of the I think this was the low in March 2020, which is shifted 90 weeks into the future. And you can even zoom in how perfectly this low matches to the real top we have seen in December last year. But I will leave it up to you to do further research why that is the case. But this is already confirmation about that this seems to be a valid cycle top of this given length here. More interesting is now when the price is crossing this so-called FLD. It's nothing more than the shifted price. And this crossing took place from the top to the downside at this point in time here. And we can even zoom in. There have been some crossings here, but the latest crossings has taken place here. Or you could use the average here. I'm not interested in the specific exact details here, but here the crossing from top to down, took place. So real price cross the FLD into this direction here. So now this point is becoming more and more interesting as we look at the price series here. What this means is, and now that's where you need to understand the concept of FLDs. Once these breakpoint or this price movement crossing below the FLD has happened, it is a confirmation that the top is in. It's now a very lagging information, but this is the confirmation that the 182-week cycle has topped at this past high here, because that's the confirmation at this given point in time. We are crossing below, the confirmation of the top is in. And based on that information, we can now derive two very important information. One is, as we know that this is the point in time at which this crossing here appeared from a time perspective, is 1/4 of the full cycle length. So we count from the top. This is the confirmed top. And this time span here is 1/4 of the overall cycle length. So we can now add the same amount of time into the future. So I will just visualize it here. And this is then, half of the full cycle. So I'm just doing it live. From here to here, this is where the crossing takes place. This is 1/4 of the cycle length. And to complete the full downward cycle here, so from top to bottom, from a theoretical cycle, we need to add another 1/4, which is exactly the same length, which will then give us the point in time when the timing low will be expected for this 182-week cycle based on real price movement. So this helps us now to derive the skewness of the cycle, because we never see perfect symmetric cycles. So now, once we cross the point, we can now use this information. We know how long it took to arrive at that point, and we could assume it will take the same amount of time to complete the downward cycle of this approach based on the behavior of the past cyclic behavior. So the timing information now helps us to derive a better timing projection. So instead of having this theoretical bottoming here, we know that we are before that bottoming period. That was my initial question. At this point in time, we really need to have additional information. Have we already passed the theoretical bottom, or are we still ahead of this possible bottom? And now the FLD gives us some information in regards to timing of this information. So that's one important part of the story, timing-wise. And this information can now be used to adjust the skewness of the cycle. Do you know what the skewness of the cycle is? I would refer you to, that's the first concept I want to refer you. There's an article in our Cycles journal I've written 2 or 3 years back. So it's the volume 48, number 2, 2021. So you can see, you cannot see the link here. So this is the link at the top of the page. I will also post the link in the video description just after this session, and you can read this article. This article is about that the business cycle is not symmetric as a theoretical cycle. So the real business cycle is shifted, or is a 3-phase cycle. So you know that the green cycle here is the theoretical cycle, which we always try to simplify the timing, but the red cycle here is now the skewed cycle. And the skewness means that the distance from top to top and bottom to bottom is still the same. So we use the same length of this cycle, but instead of having the same amount of time from the left to the right, we know that this is a 3-staged cycle. So there's one shorter downswing, which is then causing the price to fall, and then we have 2/3, which in additional then are required for the upswing to complete. So this is skewed to the left, but you could also have the same skew to the right. You never know what the skew is up front of each individual cycle. We just know that we have the skew factor for each cycle. And there's a lot of theory and scientific analysis out there. For this example here, I just referred to scientific research from Fatas and Miho, 2013, but you will find a lot of scientific research which confirms that the business cycle and in financial data is skewed. So we know that we need to skew the cycle to get better valid timing projections. And the FLD now gives us a way to decide which skew factor should I now apply to the cycle analysis. So as we now are aware of the information that we need to skew here, in that case, the possible low more to the right, we can now add the cycle skew factor to that analysis. You know that we have in the configuration panel, we can go to advanced settings, we can activate the cycle skew, and we now need to shift it. I will not go into the mathematical details here, but we now can shift it that the possible low from this long-term cycle is now shifted into the future, which will not alter the cycle length. That's the important point. We don't change the cycle length. This cycle, which is seen here, is still the dominant cycle with a length of 182 weeks. It's now just skewed to the current real behavior of the price action, which is dynamic. It's the principle of variation. And now we have applied this to the cycle analysis. And to even show you the beauty of this detected skewness, I will even go back to the longer term analysis. Also apply the skew here. You can read the article for further mathematical details on it and apply the same skew here into our projection. So now we see also from our projection that we are ahead of the bottom, right? Okay, so this is what the FLD showed us, but now we have adjusted our cycle analysis. And the beauty of this skewness, I mean, let's go back to 1930, even to the beginning of this cycle analysis. And even here, you see that this skewness with this static cycle gives us an almost perfect timing right 100 years ago. And let's move forward in time. Let's move to 19 here. Let's zoom in here. Do you see? I mean, the skewness almost perfectly matches the top and the bottom here, 1969 to 1975. So same skewness here. Let's continue to the internet bubble in 2000. Here you see the same skewness applied now to this cycle, perfectly matched over 20 years ago. So I've not changed this cycle here. Here, the banking crisis, 2007, the topping and the bottoming here. I mean, this is a cycle now plotted 100 years back with this cycle skew here, the bottoming of this COVID crisis here and the topping process here. I mean, you see that with this skewness, you can even go 100 years back in time, and even almost all big turns are beautifully aligned to this skewness. How did we detect the skewness? Using the concept of future line of demarcation, measuring the distance of time traveled for the price until it crosses the FLD of the detected dominant cycle. There you are. So this is the technique to fine-tune the timing of our theoretical detected dynamic cycle. This works on every time frame, weekly, daily, and you can use this information now to better fine-tune. So that's why I think we are still ahead of the dominant cycle, weekly, long-term to bottom. We have not passed it. So I cannot switch to a bullish case here using cycle analysis from the long-term period. Second, and I will not go into much more details here how to use the FLD, and this is what is mainly used for, to be honest. The FLD is mainly used now also to derive price projections. So we're talking here about time projections. But if you follow the concept of FLDs, the beauty is also that it allows to build now price projections. Our price projections built out of FLDs. You use the point of the crossing here and then measure the distance from the past top, which has been traveled until this crossing has been passed. And now you apply the same principle to price. You would assume that the same amount needs to be traveled down to arrive at our price target here, because this is just half of the downswing. So we had discussed the timing, but also from the price movement, we should also need to move down. So now you have the price target derived, which is approximately here. At this point, that's the price target now. And we have the timing here. So now by combining these techniques, you have now a price and time target based on the analysis of dynamic time cycles in addition with FLDs. So this will be interesting to watch. I'm not a big fan of price targets, but you know my dear friend Peter Eliades, which has been here on the channel, he has more or less mastered the principle of FLDs. He's not just using one FLD, he's using the continuum of 2 different FLDs and draws this as a channel to have better confirmation than this simplistic version I showed you. So Peter Eliades is using the concept of FLDs for over 50 years, and he has been really trading these techniques in public funds here. So Peter is more or less a master of really using FLDs live out there. So we have now adjusted our weekly analysis. And another interesting question will arrive. Yeah, Lars, let's now move to the next shorter time frame, which is the daily series. Now let's do that. Let's see how we can optimize our daily routine. So we have our weekly projection, which is now looking into late summer this year, or late summer this year. So now we go to the daily chart. Here we have the daily chart. And now you look at the spectrum, and now it's not as easy as in the past to really pick now. So which cycle peak from the spectrum should I use now? This one? This one? This one? Or maybe even better, that one? So that's often a challenge we are facing as cycle analysts when using with this kind of spectrum information. I mean, for sure, we can now add more data and refine the analysis, but we want to have a current projection, and therefore it's not really an option to add more and more historical data, because we want to fine-tune the current projection into the future. But now we can use the knowledge we have from the long-term analysis to derive some conclusions what to use on a daily chart now. So let's start with the concept of the FLDs. We had 182 weeks dominant cycles on the long-term chart, even going back 100 years. I showed you why this cycle can be used, what the current timing is, how to apply the skew, the perfect fit of the skew, the projection of that. Now, we used 90 weeks to shift the FLD in the future. It's just half of the length of the dominant cycle. So now let's convert 90 weeks on our daily chart. The chart we are using here has market days, so we don't include weekends here. So 1 week equals to 5 market days. So 90 weeks multiplied by 5 market days. At what number do we arrive using the offset for the length of the FLD on a daily chart? Come on. 90 weeks multiplied by 5. I mean, it's easy. We don't need to wait. But the number we need to put in here is 450. Correct? Yes. So that's the shift. I mean, no surprise here. It's not really showing up different here. I shifted the FLD 450 days into the future. That's the equivalent for the 90-week cycle on the weekly chart. And here again, just the beauty. No? The low from 2021 is more or less the perfect match of the top we had at the end of 2021. Yeah, I will get back to the 225 in a second. Maybe you can comment on yourself why I used 450 as a plot. That's 182 weeks is the dominant cycle length. Half of that is 90 weeks. 90 weeks multiplied by 5 is then the offset we use on a daily chart. Okay, so let's get back to that in a second. So now you might ask, how does this help in now? Because we are coming from the spectrum here, which cycle to plot. Now, another concept which is very important in cycle analysis is the harmonical theory, or the concept of harmonic related cycles. So if we can assume that the most dominant cycle is the 4-year cycle, 180 weeks, and half of that is 450 market days. So the full length of this cycle is 900 market days, right? So 900 market days is the full span of the dominant cycle, which is then around 1000 days, and that's exactly the 4-year cycle, which we talked about. So if we know that the cycle length of 1000 days is the dominant cycle, let's now see what the spectrum shows us. And let's start maybe here, 277 market days. So 277, and I mean, I know this upfront, multiplied by 4 gives us around this 1000 days, which is the 4-year cycle. So we have an harmonic relation of the 4-year cycle divided by 4 gives us the length of around 277 market days. So the daily cycle, which has a harmonic relation to the dominant cycle of 182 weeks, has a length of 1100 something. And if you divide this number now by 2, I hope you can follow me, 1108 divided by 2 comes to our 500 something. So that's close to the 450. We shifted this cycle into the future. So which gives us the information that by using the let me maybe I've confused you. Let me restart the analysis. So the harmonic relation of 277 multiplied by 4 gives you the 4-year cycle. Let's simplify that. I think everything else was a little bit too chaotic from my explanation. 277 multiplied by 4 equals the 4-year cycle, which then in weeks, if we derive this into weeks, gives us around 220 weeks, using market days here divided by 5. This is exactly the 4-year cycle, which is currently on the weekly chart 180 we have detected, but on the daily chart we don't have the exact recalculation of 180 weeks. So the daily cycle, which is currently with around this is the weekly, with 277 market days, is the 4th harmonic of the 4-year weekly cycle. I hope you got this, so please bear with me. But that's the important point I want to make. So if we apply harmonic relationship to the 4-year cycle, which we have derived from the weekly, we can now conclude that this peak here in the spectrum is an harmonically related cycle of the dominant 4-year cycle, though the 4th harmonic of this cycle. And that is now a reason why we could pick this cycle on the daily chart, because you should always prefer harmonically related cycles if you pick them on then lower time frames. And we know that this is now a 4th harmonic related to the weekly cycle, which is a perfect harmonic relation. So the 4th harmonic relation is also very common, and it's a beautiful resonance here. We can use the same analysis now between the FLD and the price. I will leave this up to you then in a later stage, or you can do this on your own. So, but we can apply now the same skew factor we have detected on the weekly. The same will be detected on the daily, so we need to apply the skew. So now here we have the daily harmonic related cycle to the dominant weekly cycle skewed with the same amount here, which gives us the current projection on the daily time frame here. And this is what we are looking for. So this harmonically related cycle with the current phasing and the skew factor also gives us August as possible down window for this daily cycle to bottom. I mean, that's no surprise that this is aligned with this cycle top here, because that's the skewness now of the analysis. So we combine the result from Hurst and the FLD, which gives us the phase shifting. We convert it to a skew factor to update our cycle model. We could also do a price projection here, but I will leave this up to you. What I want to highlight now is that this also is interesting to see that from the long-term perspective, the long-term and short-term cycle until October last year have been in alignment, where we saw the big downward push in the markets. And then since October, as the daily cycle switched to the upside, while the weekly was still looking down, resulted in this, what really is boring us in the markets, resulted to this sideways movement. But that is no surprise, to be honest, because if the shorter term cycle, the daily cycle, is against the long term cycle, this can often result in just pausing the dominant downtrend. And this is what happened. We have not really seen a new bull market starting. Yeah, it's just that the downtrend, which started October or let's say early 2022, has now been paused since October last year. And we're really waiting now for the market to make a decision in which direction it should go. Now, interesting is that this cycle from the daily turned now to the downside until July. So maybe the larger downswing cycle from the weekly could continue now in the late summer. And that's just why I wanted to pull this up and bring to your attention, because we need this kind of fine-tuning the symmetric cycle analysis. So if we just relate to our basic timing analysis, we just get these theoretical timing of these cycles. And once we arrive at the projected turning points, we never know, are we now before or have we passed the turning point, or are we at the turning point? And that's when you need to apply additional frameworks and techniques to get more conclusion about what cycle to maybe pick, how to skew it, use the concept of FLDs to get the dynamic behavior in regards to time, price, and that's just the reason why, from my perspective, just reading cycles based on this analysis. So I'm no expert in the markets, in the macroeconomics, in whatever is out there in the financial world on price. We're doing pure cycle analysis. So that's what cycle analysis tells us. I mean, the market will speak on its own, but we do cycle analysis. And I think the concept of harmonical analysis gives us a clue. Once you see a lot of peaks in the spectrum, choose the harmonic related cycles to the more dominant long-term cycle. Yeah, one conclusion for today. Second, to fine-tune the timing window, use FLDs and monitor when or if the price shifted forwards by half of the length into the future to detect where we are in the cycle. Have we confirmed the top or the bottom? Yeah, it depends on the perspective, what you're looking for. Measure then the time until the break and price to derive price and time targets. And take this into account then to skew your cycle projection and to detect on lower time frames which cycles to pick, which are in harmonic relation to the larger ones. Okay, long story, lots of concept throwing into the mix. I hope I have not confused you too much, but I think I wanted to use the current market situation to make a practical example out of harmonic theories, future line of demarcation, and dynamic time cycle analysis using the spectrum. So if you combine all three knowledge areas, it really helps you to see something. Yeah. Often, if you just relate to this theoretical cycle to a spectrum with 5 peaks, it's not easy to work with. But if you start to combine the different concepts, it becomes more and more clearly for you what you see in this chart. And that's the purpose why we are here. I think you can now reach out, dig into harmonic relations and harmonic analysis. Our colleague Ray Holmes, my colleague on the board, he's an expert on harmonic relations. We have a video in the archive on exactly that concept. I have spoken, at least on this channel, 2 or 3 times with Peter Eliades, who's an expert on Hurst FLD technique to derive trading decisions. You will find lots of content out there on FLDs and Hurst. So I think that's now up to you to expand your knowledge area in these areas, and at least I triggered a little bit how you use these different concepts and bring them all together. At least the video is now here and you can repeat the analysis. Okay, I will now switch to your questions to see where I can help you out most. Let's first stick to the concept. Maybe Pete, starting with your question here. So Pete, so more or less you're aligning the 4-year cycle with the peaks of the 100-year cycle based on past data. Yeah, let's be careful to not mix things up. So I used 100 years of data going back to 1920 something to do the spectrum analysis. So that's first important to differentiate. So we use 100 years of weekly data to detect the 182-week cycle in past data. Then we pulled up this cycle on the chart. We did an overlay with the current average phasing. And then I derived the knowledge on which skew to apply based on the FLD, which shifted the tops and the lows by not altering the length of the cycle. Yeah, we keep the lengths, but we shift the length of the downswing and upswing. And then I just cross-validated. Yeah, I moved back in time. And this was just cross-referencing. If the skew found on current price dynamics and the length found of 100 years of data, if this skew factor then plotted on the chart does fit with major important tops and bottoms in the historical data set. And that's why I just quickly scrolled over the 100 years weekly data series and showed you, I think, 1921, 1960, 1970, the internet bubble, the banking crisis, 2007. So this skewed cycle was a beautiful, beautiful visual fit on tops and bottoms in the S&P 500 using 100 years of data. So it's not just aligning, it's just the visual cross-check if this would have made sense even in the past, what we're doing based on current dynamics. Peter, I hope this explains it a little bit. Shuba Tendon, you are coming up with the 225, and maybe it was my fault to confuse you with all of these numbering. So the correct number was 450 days. So it's just that the dominant cycle was 180 weeks weekly. Use half of the dominant cycle, comes down to 90 weeks. Do we want to bring this on a daily chart with market days? So 90 weeks multiplied by 5 market days a week gives us 450 days on the offset. 90 weeks was already the offset. Otherwise, you need to halve the dominant cycle. So I think I confused you there a little bit. So the number was 450 on the daily chart. But I would keep it to my fault, mixing up too many things. William, when trying to decide on the best cycle length, if 182 weeks is strong, then should we just divide that by 5? To get, you mean you want to get to market days, then you need to multiply, not divide. So let's be careful here. 182 weeks. If you want to use this on a daily chart, you need to multiply it by 5 market days, to get to the lengths. Not divide by 5, multiply by 5 if you want to bring it down to daily charts. Yeah, Stephen. Love resonance and harmonics. I hear angels playing harps. I like this more or less joking or funny comment, but it's absolutely true. This is also related to musical theory, or if you're playing music and if you are in reading notes and music scales, and what beautiful sound of music sounds like is harmonic relationships. And I've already prepared the just to play it here for fun, the fourth harmonic, how it sounds from a musical perspective. So let's play it. So you will now hear the fourth harmonic in music. Yeah, so 2 tones with a distance of exactly the fourth harmonic. So listen to it. Can I play it? Just a second. I need to play it. These are 2 musical notes, the fourth harmonic. They sound beautiful because it's the fourth harmonic. If you choose the wrong harmonic, so if you're sitting in front of a piano or harps or guitar and you choose 2 tones which sound crazy, they don't have this harmonic relation which our ears will receive as beautiful. So this is good music, uses the right harmonics between different notes, that they sound right, they sound correct. Yeah, just hear it again, just for fun. Fourth harmonic. This is what we're seeing in markets right now, just converted to music. But that's Stephen, I like your comment here. Right. Yeah, Stephen, maybe just to get back to cycles theory. Can cycles invert? Seems everything in our world is inverted. The topic of cycle inversions is a very, very complicated and not researched one where we have a clear answer. Often I see this more as an excuse if a cycle is not correct or price is moving the other way. You could use the simple exclusion, this cycle has inverted. I don't like this exclusion, to be honest, and there's no scientific fundamental knowledge given that these cycle inversions occur. My research at least is that at cycle midpoints, or at the midpoint timing-wise of a downswing or upswing of a cycle, there then often strange things happen. And that the midpoint of a cycle is, by the way, also the crossing of the FLD. Yeah, so the FLD and the arrival of price to the FLD, so at the midpoint, is always a very important action you can observe also on the FLD. So either then the FLD often also acts as a kind of resistant. So when price turns, so that the cycle is not confirmed, but I would not call it an inversion. So the concept of inverted cycles is a very, very complex topic without any clear conclusion we have right now. Okay, Peter Eliades. You will find his analysis. Let me bring Peter's analysis up here. So he's a long friend of the foundation. He's often showing up here, and this is Peter's homepage, stockmarketcycles.com. And that's Peter Eliades, which I want to refer to. And he's in the markets for over 50 years, longer than most of us. And he's really using cycles. And as I said, he has mastered the concept of FLDs. He's not calling it that way, by the way. You will not find him naming it FLD. But if you look how he's using it, he's more or less perfect use case of this concept. But William, I hope this gives you some more reference. Okay. Yes, but maybe Florian, very interesting and helpful. One question: don't you think that the downturn in the market should be shorter than the upswing in the market? Yeah, that's a topic I cannot clearly answer that, but it's related if we are in a longer-term uptrend or longer-term downtrend. I think this long-term trend then will derive if we have left or right translation of shorter-term cycles. So if we are in a long uptrend, then for sure the downturn will be shorter and fearful, and then we again enter the next upswing in this longer-term uptrend. But if this situation shifts, so assuming that we are now in a longer downtrend, then it could be exactly the opposite. Then we will see long periods of downturns and then just short upswings. So it's a question, however you judge the current trend of the longer-term trend of the market, this will then give you some clue on if the downtrend or the uptrend will be longer or shorter or the other way around. So that needs some more attention then for the judgment. Okay. Yeah, Brent, maybe thanks for this hint here, and maybe it's a good point to do further research out there, a quick and dirty approach to FLDs. If you can't put them on your chart, maybe that's a simple way. Plot half of the period of the dominant cycle rate of change, in that case 90 days rate of change. So can use this then as another indication how to fine-tune technical indicators. That's often concept I'm referring to, and maybe now you also understand why I'm always use half of the dominant cycle. And that's also, Brent, what you refer here to. Let's use 90 weeks. Yeah, and in that case, 90 weeks, not 90 days. Let's be careful. Or use 450 days. Would be a long setting for a daily rate of change analysis. And then 0 is the crossing with the FLD. Thanks, Brent, for mentioning that. So always think about how you can transfer this knowledge to the price chart. And I would leave you as a community with this suggestion from Brent. Thanks for bringing this up here. Up to you now. Switch to the price chart, use the rate of change, apply half of the dominant cycle. This can give you a clue on the FLD, or even think about it. Right. So a lot of topics have shown up today. I think our brain should now spin around cycle analysis again and give us a lot of clues what to do with cycle analysis in the context of the current market behavior now. Isn't it beautiful? We can do live projections. I don't know what happens, but that's my take on cycle analysis, combining all these sessions. We are approaching 1 hour of stream here, so let's close it for today, right? Meet me next week here, same time, same place, Cycles TV. Let's analyze markets. Let's see what happens out there. Join live, bring in your questions, like the channel, recommend the channel, become a member of the foundation. You are invited. I want to see you next week again. Have a nice week.